Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
This is Lance with Real Estate Risk Report. Today I have with me Bryan Pritchard with Tricap Residential. What is it? Tricap Residential Group?
It is, yes.
Official name?
It's the official name.
With Tricap to me. So very good. Well, thanks for having us, Bryan. How you doing today?
I'm doing great. How are you?
Doing good, man. So why don't you just share a little bit with us about sort of your, where you guys do your deals, the types of deals you're doing. In this case, multifamily, but just give us a little color on sort of what kind of deals that you guys are doing and where you're doing them.
Sure. So we are exclusively multifamily deals. We're middle market value add, which today means we're buying typically 70s and 80s vintage apartments. We are renovating and repositioning those communities. They're generally suburban, although we are based out of Chicago, so we have a couple of city assets as well. We're renovating to the tune of $15,000 to $20,000 per apartment, and then our investment horizon is typically long term. So we're doing that with usually with some sort of bridge or long term debt vehicle right out of the gate. Got it.
Very good. So for you, how deep is the value add? I mean, how much on average what kind of budget do you have per door typically?
Yeah, it's pretty deep. We are. It's not a new coat of paint and a countertop. It's really much more extensive than that. So on the interior of the apartment, that's usually in the $13,000 to $15,000 range per unit. And then when you add in the common areas, that's usually another $5,000. So all in renovation budgets around $20,000 per unit. We see that as, for this vintage of property, that's on the high end of what people are spending. And there's a reason behind that. It's all of these little components that you could cut in order to reduce the price, we think significantly kind of degrade the high quality apartment that we're trying to deliver to the marketplace thereafter. And so we feel we're better off doing a full renovation, and delivering a high quality product into that market at an affordable price rather than doing something kind of middling the middle, in between.
Yeah. And what type of vintage? So how old are most of these assets that you're buying? Like, are they 80s builds or?
Yeah, typically 70s and 80s. And it kind of depends on the market that you're in and what the, development appetite happened to be or development happened to be in that time frame. We're in 7 states, predominantly Midwest, but we're also in Tennessee and Alabama and kind of moving our way into the Southeast as well. We find that in our vintage, really no matter where you're at, most of the apartment complexes are pretty similar in terms of, certainly in terms of kind of construction type, but also really in terms of layout and unit sizes, et cetera. So it's a pretty similar thing that we're doing every time we acquire a new asset.
And how big are most of these? Are they, how many doors are you typically?
Yeah, on the small end, we would do 100 and 150 units per community. And on the larger end, our largest asset is 550, single asset, 550 apartments.
Mm-hmm. And then is the strategy typically to renovate all units or are oftentimes some of the units have been renovated by a prior owner or, how does that kind of work?
Yeah, sometimes there's been a little bit of a head start by a prior owner. Not always, but sometimes that does happen. Typically, when we go into an investment, our business plan includes renovating all of the units in all the common areas, and we're capitalizing that expense up front, meaning we're not going into a deal that's only got enough money to finish 30% of the apartments, and we're hoping on somebody to kind of take us out or bail us out, when we get to that point. We're planning on finishing the whole thing, and if for some reason there's an opportunistic situation that would allow us to sell early, we would consider it, but we're planning on going the full distance.
So I know like when you do these deeper value add strategies, there are some people who will, literally go in and move people's stuff out in the morning and renovate the unit, move them back in the the evening, or, you do it as people sort of obviously vacate and those things. So, I mean, why don't you speak to sort of like the differences, or maybe the strategy that you use, why you use it, and just giving some more, color around that, and the kind of risks that happen if you do sort of try to renovate the units while the residents are in there.
Sure. Yeah, we do not subscribe to that plan, and I'm not opposed to it. It's just the level of renovation that we're doing doesn't really allow us to do it in one day.
Yeah.
And so our business plan is, when you look at an apartment that we've renovated, it's the same interior finish package that you would get in a new construction apartment community down the street. So when we're done, it looks and smells and feels like new construction. It's just in a beautiful 70s or 80s shell, and we usually rent for about 30% less. So for us, that's a real value proposition for a renter coming into the marketplace that says, I can get the same interior finish package, in a 1970s or 1980s property for 30% less than new construction. I'll take that. That's a good deal.
Mm-hmm.
And so that's the underlying premise of our business plans or investment strategy. So the reason we can't move somebody out and move somebody in is really the amount of things we're doing in an apartment. So typically it involves in the kitchens, cabinets, countertops, sinks, fixtures. We're generally replacing door and hardware packages. So you're getting a brand new set of doors. We're doing high-end closet organizers in the units. In the bathrooms, just kind of depends on the situation, but typically a tub surround. And vanities and toilets and fixtures. And then the other thing that complicates, a move in, move out scenario on the same day is we put all new floors in. We put a laminate vinyl floor in, which really pulls the whole unit together, but it certainly can't be done in a day. So our hard renovation timelines are about 30 days. Somewhere between the 30 and 35 day timeline. And then there's a little bit of time on the front end to move somebody out, and a little bit of time on the back end to move a new person back in.
So how many can you renovate at a time then?
It depends on the community and kind of how we've structured renovation. We typically try not to do too many. Our business plans generally favor occupancy over speed of renovation. These are also cash flow deals for us, and the best way to destroy cash flow is to vacate your property. So we're trying to keep occupancy in the 90% range during renovation. And so depending on the size of the property, we'll do 10 to 15 units a month. If it's a smaller property, sometimes less than that. And we find that that's just a manageable pace for everybody, for our own maintenance teams, for our own construction management teams, and the contractors as well.
Yeah. I mean, when you are, in communities that you aren't, how do you guys manage that construction process from afar?
Yeah, so we have, we're an execution firm, and to me that means all of the operations that happen at a property are employees of our company, and we have at times tried to use third parties for that type of work, and it just hasn't worked well for us. We're very impatient. We have a very high degree of standards, and so when we get other people that don't work for us working on this stuff, it just doesn't work together. So the property staff are employees of our company, so leasing agents, property managers, maintenance technicians, and supervisors, and then the construction management teams as well. So the project managers, and then we have some senior level construction people that are managing the ongoing renovation. The laborers that are executing the renovation are usually subcontractors or other types of vendors, but we manage the schedule and budget of that work.
Got it. So the alternative then is that I'm assuming many other sort of multifamily syndicators aren't doing that?
Yeah, I would say the alternative is, or at least what we see is, I think there's really kind of two routes that you can go in this space. And one is to be a capital shop and one is to be an execution shop. We are an execution shop, and we happen to raise funds in order to make our business plans move forward. On the other side of it is there are capital operations that raise a bunch of money, and then they have to go find vendors or third party people to execute the work in order to make the deals work. It just happens to not be our business plan. We find that in this space, the level of control that you need over the nuanced operations of an active renovation at a property is too great for us to, give that to a third party and hope that they do a good job.
Yeah. I mean, and that goes too then into, kind of moving, prior to the value add component, but in assessing whether you do a deal or don't do a deal, I think everyone sort of, a couple things. Everyone wants to say that they bought their stuff off market. They want to say that, they've acquired it at below replacement cost. But for you guys, when you're assessing, opportunities or deals to acquire, especially since you're going to be executing, a decent amount of value add, which increases the risk, of course, just in once again, in execution. How do you deal with that process in terms of trying to make sure that, especially in a rising market, now where we've kind of hit the top, and obviously with the COVID-19 stuff, it's somewhat shaking it up a bit, but, how do you make sure that you get in at the right price? It seems buying it at the wrong prices can really hamstring you.
Well, I'll address those first two things that you brought up, and then I'll talk about, the different risk components that we see in a deal and how we mitigate them. And the first two things that you brought up were buying below replacement costs and buying off market. In our vintage, your 70s and 80s vintage, I hope you're buying below replacement costs because it's a 40-year-old asset. And so if you're buying above replacement costs, it's probably not the right, investment. Just like we try to maintain a rent discount of 30% to top of market, we're looking to be at least 30% below replacement cost when we consider our all-in, cost for the project. With regard to off market, I'll walk you through a little scenario. People call me all the time and say, "Hey, we have a buyer for your property." Okay? And my answer is, sure, I'll entertain an offer if the number that they're going to give me is so ridiculous that I would have to sell, or it would be it would be irresponsible of me not to do so. Mm-hmm. And so I'm certainly not the only person who thinks like that. And so if you're getting something off, somebody's buying something off market, to me, that doesn't necessarily mean that you're getting a good deal, especially at the size of asset that we're buying, which are significant in nature and require professional asset managers to come in and acquire them. The disconnect for a seller would have to be so great that their perception of what a too good to pass up, offer would still have to be below what the market value would be if it was marketed in order for you to be getting a good deal. So we don't really believe in a better price for an off-market deal. You might clear some competition, but it doesn't mean you're getting a better price.
Yeah.
So when we assess risk, on market, off market is kind of irrelevant to us. It really just depends on what the total cost of the deal is, purchase price being one of those factors. But if you think about what the risk points are, you have operating risk, you have renovation risk, and you have capitalization risk, and how you're financing or putting that deal together. And I'll touch on each one of those. The easiest one is renovation risk. What's the cost of construction or the cost of renovating a particular property? We do the same thing over and over again. And so the band within which we work on renovation cost is very narrow. So when we go into and they're all generally of the same vintage and generally have the same deferred maintenance, if any, in construction type. So when we go into a deal, we generally know exactly what it's going to cost us, or with a very high degree of accuracy, what it's going to cost us to renovate a property. And we've done this so many times that we know how long it takes, and we know what the process is in order to kind of vacate units and renovate them and put them back on the market. And so for us, we feel like that risk is pretty well mitigated. Again, this is all we do.
Yeah.
Then you have operating risk. Again, this is all we do. And so whenever we want to see how much it costs to run a property, we just go look at our current portfolio and say, how much does it cost us? And we use per unit, per unit per year metrics to do that. How much does it cost to staff the property and market the units, and what are our G&A costs and repairs and maintenance and turnover expense, et cetera. We have a very high degree of accuracy within which we operate. So it doesn't matter what the seller's doing. We know what it's going to cost us to run our operation on that particular asset. The nuances between markets are insurance costs, which do vary by state and region. So we'll use our insurance providers to help us mitigate that risk. Real estate taxes is a big risk point, and so we do our own estimates, and we use third-party tax professionals to help us say, hey, here's what the tax bill is today based on your purchase price and what you're going to do. This is what it's going to look like tomorrow. And so we're actually pretty accurate, if not somewhat conservative with regard to real estate taxes, because it could have a big impact. Mm-hmm. And then the last piece of operations is what are you going to do on the revenue side? So this is really what it all comes down to. How much can you get in rent after you renovate an apartment? And so we spend an inordinate amount of time assessing what's going on in the marketplace. We're looking for deals in that market that may have executed a similar business plan to us, and what rents they've achieved. We're looking at people that have done less than us. We're looking at people that have done more than us. And we're looking at who's getting the most rent in a given marketplace. And we're using all of those data points to figure where we slot in that rental spectrum. Mm-hmm. All of these markets have a rental spectrum, with low income to new construction. And usually we're buying something that's kind of middle and moving it to slightly higher. It's not like we're taking something that's a low income property and moving it up to into a high income property. So that's how we assess risk on the revenue side or the rental side. Mm-hmm. And then the last piece is how you capitalizing your deal. What sort of debt and equity structure, and if you're into it, preferred equity or mezzanine structure, are you putting in place in order to finance the total cost of that investment? For us, we're pretty conservative. We are typically using a Fannie Mae or Freddie Mac loans on our property. So we're taking long-term fixed interest rates up front and then putting some common equity or investor equity behind that. So we feel like our debt risk or our capitalization risk is pretty low, and we don't use a lot of leverage. Our deals are leveraged as a percentage of cost, 60-something%. So we feel like we mitigate that pretty well.
Yeah. So speak to that. Like, once again, let's speak to some of the alternatives. So you're conservative. So you obviously, there's a method to your madness why you're doing that. I mean, how does it make you feel, or when someone gets super aggressive, or like what you would consider reckless in terms of how it capitalizes a deal like this?
A couple things that I consider to be just irresponsible. One is how you apply growth rates to income and expense over a long period of time and use that as the underpinning of your investment. And what I mean by that is, if you're taking your revenue and saying, okay, I'm going to raise rents to $1,000 per unit, and then I'm going to grow rents 3% annually over a 10-year period, and then I'm going to grow my expenses by 1% annually over that same 10-year period, that's a hyper-inflated growth structure that is very hard to achieve. And while it seems like 3% rent growth and 1% expense growth is not that big of a difference, over a 10-year investment period, it has a massive impact on the value of your asset from an underwriting perspective. Mm-hmm. So, we don't use inflated growth. If we're going to grow rents by 3%, we're going to grow expense by 3%, or typically in our case, it's 2%. So that's one thing that I would look at that I think is an irresponsible way to underwrite your asset. The second is I see a lot of investments that are 5-year investments, and they say, here's a 5-year investment for you, Mr. Investor. And we've done such a good job of mitigating risk that we've put a 10-year fixed interest rate loan on the deal. And so you have a mismatch between your investment horizon and the term of your underlying debt. And one of the things that happens with underlying debt is that if you exit it or attempt to exit it before the expiration or the full term of that debt, there's a cost associated with it. And that cost is dependent on whatever the interest rate environment is at that time. And so it's very easy to say, I'm going to sell this in 5 years, and then forget about the fact that you have a cost to unwind that note because it makes your deal look good. It won't happen. I'll give you an example. We have some fixed rate debt on some properties in Indiana right now, and we are way in the money on them. Okay? And rough numbers, we have a $9 million loan that we would love to exit right now and either sell the asset or refinance it. The cost to get out of that 10-year loan in year 5 is currently $3 million. And so disregarding those extraordinary costs can be, to me, an irresponsible way to give expectations to investors. So we don't do that. If we're taking 10-year money, a 10-year agency loan, we're going to show you a 10-year investment horizon, because we want to set the appropriate expectation with you.
Yeah. Does that make it harder then? I mean, for many of these investors who want to hear that you're going to get out in 3, 4, 5, 6 years?
I think it can, although I would say that our investors are pretty attuned to what we do, and they have a very high degree of comfort with us, and they understand the long-term benefits of investing in real estate, both from a tax efficiency standpoint as well as what the risk-adjusted return can be from apartments versus other forms of investments.
Mm-hmm.
And so they're looking for yielding assets, and I would say most of our investors are not using IRR as their number one indicator of whether it's a good deal or a bad deal. Mm-hmm. They're using things like, what's my annualized cash on cash return? What is my investment multiple over that period of time? How do I lose money? What's the risk associated with those returns? And if you've kind of put some conservative projections in place and you've mitigated risk, I think our investors are very appreciative of that. They're definitely not IRR chasers.
Yeah. And so in terms of the capitalization, it seems like a lot of guys, especially in the value add play, then they're putting more short-term debt on it, and then they're refinancing when they force appreciation. It sounds like you could be doing that.
And we have in certain instances. We're certainly not opposed to that business plan as long as it includes moderate leverage or responsible leverage. We just find, especially today with interest rates as low as they are, that's a big expense on any deal. I'd rather take that risk off the table today. And the reason we like to capitalize deals with Fannie Mae and Freddie Mac loans is that those two agencies give us the ability to go out and get additional debt if we've done a good job of increasing NOI over a period of time. So generally, when we buy something and we have a 2 to 3 year renovation plan, we'll include a year for what they refer to as a supplemental loan, which is an internal form of refinance for Fannie Mae and Freddie Mac that we will utilize.
Okay, got it. So they'll extend you more capital, allows you to return some capital to the investors.
Exactly, assuming that the asset or the NOI from the asset justifies it.
Right.
And all of these things are typically, our leverage rates are typically capped at 65, maybe 70% of value at any given time.
So with your strategy, then, is the way that you set up your capital structure, does it allow you then to participate in some of the operating income as well, like for your firm, or are you, since a lot of times too, these are driven by, 10 years is a long time to, before you get your sort of promote. That's
Yep.
Part of the problem with the whole industry is that it's all back end loaded. Everyone wants it to be based on performance, but in order for you to, reap the benefits of all your hard work, you have to sell the asset. If you're waiting 10 years to do that, it's just, how do you manage in the meantime?
Yeah, look, real estate's a long, slow endeavor. That's just what it is. And I have people tell me all the time that younger individuals who may be interested in starting their own business or getting into real estate, and I ask them directly what their kind of expectations are for how much money they're going to make. Then usually my advice is you should stop what you're doing right now and start a tech company. Because it's not going to happen in real estate. And if you want to make real estate is a long-term, generally conservative wealth generating investment vehicle. And so for me personally, and I personally invest in all these deals, and I literally have my entire net worth and my family's net worth invested across all of these deals. So I certainly am a believer in it, and I have definitely put my money where my mouth is. You got to wait. It's a do well, slow game, not a do fast. Do something fast.
Yeah, no, that's amen. I agree. That's the nature of the game, but it keeps you busy in the meantime. And I guess
it's a grinder's business. It's a grinder's business.
A grinder.
Okay? It's a very unsexy grinder's business. We some people think that we have a sickness. We happen to like the grind. We actually like the property operations business. The whole company gets a lot of joy out of that. And so if you like what you do every day, and it's financially rewarding over a long period of time, that's not such a bad way to live.
Yeah. And I suppose too, it's like you said, you're an execution shop. So the fact that, and I think that it's obvious when you go to your website in particular, which is very, I think unique in this space, is that when you go to your website, it's very clear that you're marketing to employees. You're trying to attract talent, which is interesting because obviously your constituencies or stakeholders would be, interested investors, obviously tenants, which, you have individual websites that appears for each of the properties. So that has that, but the main website is targeted at come join our team. So tell me a little bit about how you arrived at that being important, which I think underneath that is just, you value culture. So at this point, if I go on a limb, I'd say that you believe that culture is a differentiator.
Sure. No, that's an absolute, and so, like our industry is not different than most in that the customer really drives what happens in our business. And so if you're not attuned to what the customer wants, there's way too many options in terms of apartments in the world, and there's way too much visibility into how a landlord or property owner is treating its customers, in the form of resident reviews and, all sorts of online forums, for you to be ignoring those two factors. And so if you aren't putting forth a really high quality product at a price that's in line with the marketplace, and if you aren't doing a great job of taking care of your residents and earning those high marks and customer reviews, which are all online, all over the place every day, we just don't think you can be competitive over a long period of time. And so the majority of our focus and efforts and time that we spend every day is in developing our own teams, hiring great people, making sure that they have the skills and the tools and the authority to make decisions on behalf of the business, and also making sure that we have a structure in place that trains them not only to be professionals in whatever they happen to be doing, trains them to be future leaders in the organization. So as our organization grows, and we grow from within, there's a big emphasis within our organization.
Yeah, no, I think that's great. And I think that's, once again, when you go, it is a way of mitigating risk. In fact, it's a way of growing, shareholder value. I mean, ultimately those who have.
Well, that's really what it comes down to, right? Is so that we could make an investor site and tell you why we're so good at, financial engineering and debt and all this other stuff. But at the end of the day, all of these assets come down to how much rent you're getting from your happy residents against how much expense you're getting, you're spending in order to achieve it. It's just math. It's a fact. And so if you're not doing a great job of minding the budget, which is half of the equation, and charging great rents and retaining your tenants and having a resident base that's appreciative of paying for them because they know what a great living situation that they're in, it just falls to the bottom line in the form of reduced NOI, which means reduced property value, which is reduced investor return.
Yeah. I mean, it is. That's how the game works. So for you, I mean, what's your vision for the firm? I mean, out 5-10 years, I mean, what are you, what are you hoping to accomplish, or, do you kind of have that internal, big, hairy, audacious goal or thing?
Sure. Oh, we all have big goals. I always wanted to grow up. I'm lucky in that I've always known what I wanted to do, and I always wanted to have a real estate business. And, as that has kind of evolved over time, I still want a larger real estate company for me. To me, that means probably, 20,000 apartments someday. So that's our big, hairy, audacious goal way out into the future. We are much more tortoise than we are hare, which means that we're not in a way. It's kind of easy to buy real estate. You just pay more than the next guy. It's much harder to build like an enduring organization and find high quality investments. And so we take our time. We make sure that we don't bite off more than we can chew, and that if we are going to be making a bunch of acquisitions and investments, that we have the right people structure that can handle them, so that we don't find ourselves, get ourselves in trouble later.
Yeah, I think that's great. Well, cool. I really appreciate your time. I know you're a busy guy, and it's been great having you on the show today. So take care. Thanks so much.
Thanks, Lance. I really appreciate the opportunity.
Yeah, my pleasure, man.